We're going to bring in our Fed correspondent, Brian Cheung. Good morning, Brian. You had a chance to look over this report. How do you think the Fed might interpret it?
Well, good morning, Alexis. And it seemed like before the March jobs report, the big thing that the Federal Reserve was watching in these monthly releases was wage growth, right? How fast were average hourly earnings going up? Because that would tell you a lot about whether or not there were any sort of inflationary pressures that would spur the Fed to raise rates. But now that the economy's been turned upside down because of the COVID-19, seems like no one's really concerned with inflation. We've heard from a number of Fed officials over the past few days that the concern is really not that we'll see any sort of inflationary pressures, but we need to focus on the job losses themselves, because each of those numbers is a person that's had to been sidelined amid this self-induced shutdown. So we have heard from a number of Fed officials that they expected the unemployment rate to hit the double digits, as we saw this morning with that over 14% U3 unemployment rate. But what was interesting is that we've seen this kind of change over the tone of the Fed speak from, let's say, for example, Richmond Fed President Thomas Barkin, and also San Francisco Fed President Mary Daly, who said in previous days that they don't expect a V-shaped recovery anymore. We also heard something similar from Fed Chairman Jerome Powell in his press conference when they announced that they'd be holding rates steady last week. Jerome Powell saying in that press conference, quote, "It may take some time for us to get back. It probably will take us some time for us to get back to a more normal level of unemployment and ultimately maximum employment," end quote, which is where a lot of Fed speakers actually thought the economy was before the COVID-19 crisis, which is why this jobs report is so tragic, is because it ended what many regarded as one of the best labor markets that we had seen in history. But Fed officials saying with low rates at zero bound, in addition to the pace of quantitative easing, hopefully they can set up the economy for a rebound whenever the shutdown does lift. Alexis?
Speaking of rebound, I mean, this is super premature here, but when might the Fed start looking at moving rates in the opposite direction? When might we actually see rates move higher, Brian?
Well, there was a number of Wall Street analysts that had said maybe the first rate hikes would be at the end of 2021. We haven't seen any sort of Fed officials offer the forward guidance with the precision of that exact year, but we have heard from the likes of Dallas Fed President Robert Kaplan, who told us that he could see the Federal Reserve holding on to that accommodative stance for quite some time. For what it's worth, it's actually a weird divergence from what we saw in Fed funds futures markets yesterday, where you actually had some contracts being priced below par, which would imply that maybe we could actually see some sort of negative interest rate in the near future. But again, it seemed like for at least a rate hike, it's not on the table anytime in the next few years.
All right, Brian Cheung, thanks for that. I want to get back to our guests now, James McDonald and Anthony Chan. James, just your take on what would you like to see the Fed do or not do in the coming weeks?
It's important to understand the Fed has been proactive and preemptive, but we still have to deal with the reality of the impact of all these businesses being shut down. The Fed can only do so much. The Fed has done everything it can do. When we see potential negative interest rates, when we see all of the continuing liquidity injections, at the end of the day, the economy still has to lift itself up. And so the Fed can only do so much. I don't think the Fed is the solution to this. In fact, I think all of the liquidity injections have created a false hope of market valuations remaining intact or even stabilizing. This market is going to come down faster and harder as a result of these liquidity injections. And so it's a catch-22. All that they can do is provide as much stability as possible. But at the end of the day, the economy has to restore itself based on our free enterprise system.
James, how are you positioned right now? It's hard to be a bear because in doing so, if you were to be a bear, in doing so, you're fighting the Fed. And over time, that's proven a tough thing to pull off successfully.
Well, you know, Brian, I'm not afraid to make a fight alone here. We're about to make more money for our investors than at any time in history. The best possible investment anyone can make right now are buying put options. If you look at any metric whatsoever, we are extraordinarily overvalued. And every day the market grows higher, these put options get cheaper. And so we're extraordinarily excited about the profits that are coming from these put options. And this is not a negative outlook for our country or a negative outlook for our economy. It is a frank, direct concept of investment wisdom. If you want to make money, you have to buy the most underpriced, best position asset class right now. And put options are the best possible investment because they are extraordinarily undervalued here. If the market simply finds its true valuation, we're coming down 50%. And at 9,000 on the NASDAQ 100, going over 2,900 on the S&P, We've got $80,000 a contract available in the S&P 500 for any put option. We've got several $100,000 of opportunity on any NASDAQ 100 put option. These are the best investments right now.
Anthony, I want to get to you because I want to talk about the breadth of the jobs lost. We always look month to month at where the jobs were lost. This month, they were lost across the board. Hospitality down 7.7 million. We saw 3/4 of the jobs lost in food and beverage. What do you make of just the breadth of this?
The breadth, Alexis, was unprecedented. We look at the 1-month employment diffusion index that looks at how widespread across all the industries. When that number is above 50, it means that basically you're actually creating jobs across industries. Here you have a situation where it completely went into single digits. These are the lowest numbers we've seen, even when you compare them to the great financial crisis. We had an employment diffusion index dropping to 4.8 from a number that was about 26 and change the month before that. And of course, earlier in the year, that number was in above 50. So this is telling you that this is very, very painful out there. And it's probably telling you that when it's this painful, it usually gets worse before it gets better.
All right, I want to thank Anthony Chan, former chief economist at JP Morgan Chase, and James McDonald, CEO of Hercules Investments, for being with us and dissecting this historic jobs report. Thank you both and be well.
Thank you.
And to recap for you, the economy lost 20.5 million jobs in the month of April. We had the unemployment rate move up to 14.7%. That is the worst we have seen since 1939, when the unemployment rate was above 17% in this country.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.